A lot of weakness that we've seen in the euro since it topped out at a plus 3-year high in mid-2018 against the US dollar has come from what had been intense diverging monetary policy outlooks at the ECB and Fed. Over this time period, we had seen the ECB dramatically alter its guidance, unconventionally committing to no movement on rates for an extended period of time, all while the Fed was pushing forward with policy normalization. But in 2019, the picture has changed quite a bit on the US side, with the Fed turning the ship around and the market now replacing expectations for rate increases with expectation for rate cuts. Interestingly enough, to this point, we haven't seen this Fed adjustment reflected all that much in price action, with the euro still sitting just off multi-month lows against the buck. A lot of this can be reconciled by the fact that the ECB has done a good job offsetting the Fed's dovish shift with ramped up dovishness of its own. Remember, at the last meet, the ECB dropped another bomb announcing an extended hold on rates through 2019 and longer-term loans. And so considering this move, it becomes a whole lot easier to understand why the euro hasn't been able to rally despite the Fed's 180. But not rallying doesn't quite equate to a continuation of declines, and what we've seen in 2019 is a euro that also hasn't wanted to be moving much lower. The takeaway here is that the euro has most likely priced in as much ECB dovishness as it can at the moment, which could actually leave some room for the single currency to finally start wanting to turn back up, especially with US data continuing to suggest the Fed could have more to go still with its repricing of expectations, meaning yield differentials moving more convincingly back in the euro's favor. This sets up an ECB decision today that we believe will have a hard time landing on the more dovish side of expectation. The surprise of last month's decision is still fresh, and the adjustments were big enough that any additional adjustment today would likely undermine ECB credibility. Instead, we expect the central bank to echo its sentiments from the previous decision, preferring to wait for the June meeting before making any additional changes to its outlook. Technically speaking, the euro setbacks off the 25.50 area 2018 high have stalled out after a massive drop of nearly 1,400 pips. This drop has taken the market back to the previous breakout zone area from 2017, when the market rallied dramatically out from multi-year low in January of that year. The implication is that after seeing such a big downward adjustment to the exchange rate, and with that adjustment resulting in a move to previous resistance, that previous resistance could now act as a form of support, especially with the pullback also coinciding with the 61.8% Fib retracement off of the 2017 to 2018 low to high move. We've already seen some bullish reversal price action this week after the euro cleared the previous weekly high to end a sequence of consecutive weekly lower tops. Still, the downtrend remains intact on a medium-term basis, and for the reversal to gain momentum, the major pair will need to clear next key resistance levels at 114.50 and 115.70, the latter level representing the 2019 high from January. But when considering what we've outlined in this ECB preview, the bullish case from current levels is, if for nothing else, quite compelling. That's all for now.